All right, for segment 2, we're going to go through a example problem that I think will really help solidify all this new material when we're selling inventory. So you should have open this lecture example called AutoWorld. I would also have up a blank T account page. That's going to become helpful. And you can fill, and you want to fill these in as we go through it. I'm going to also have up some of my notes from what we did in the first segment to kind of refer back to see exactly how something is accounted for. So you may, I'm going to be pulling those up because that's going to be some useful information as we go on. All right, so before we start, it tells us that this company's, we got a new company here, and we're starting with a cash and capital balance of $50,000. So we have something to work with, $50,000, and then our opening balance for common stock is $50,000. We could have done this as a journal entry, but just tells us that that is our opening where we're starting from. Once we have that, we are purchasing our first set of inventory. We are a small car dealership, and we are purchasing these 4 items from who knows where, and hopefully we are going to be selling them for more than this. So we're buying these 4 cars, and it says we're buying them on account. Now, you would be separating these out as 4 different pieces of inventory and keeping track of them like I have here. That's why I have them separated. But in our actual T accounts, we can lump it all together into one inventory account. So what I want to simply do is, I know these are all in thousands, so I can just add that in later. I'm going to put in the Ford price, the Prius, the Sorento, and the Cadillac. And when I add all them up, it's $71,000. So then I ask myself, what did I get? What am I getting? I'm getting inventory worth $71,000. So that's my new asset account that we're working with. This is on February 1. And then how I got it, it says I purchased these on account. And I don't tell us who. Maybe it doesn't really matter in this case, but we'll put it down here, 2-1. And we've got 71,000 from our, we'll put AP cars, because I don't mention who it is that we're buying it from. That's just telling us that we owe 71,000 on the cars. Journal entry then, just like with the T account, debit our inventory, and then credit, and we'll put this as cars as well. Debit our inventory for the 71,000. Credit our account payable to the car manufacturer. Okay, so now we have the inventory. Now, even before we open up, we make an instant sale. Somebody wants to come along and buy something. We sell the Prius. And there's I'm going to go ahead and introduce it here. The book in the chapter isn't going to introduce this until a couple chapters later, but I think it's worth going ahead and doing this now. When we get into the problems, they're not going to mention sales tax. We won't have to worry about it. So it says here that we need to tack on 5% sales tax for the state. Now in Indiana, it's 7%, but I made it 5 just so it's easier to calculate and not have a lot of cents on the end. It'll be pretty much whole numbers. And then AutoWorld marks up everything 30%. Now again, in your problems, they're going to actually give it to you. They're going to make it real easy for you. They're going to say, you bought it for this and you sold it for this. I want you to see it in more real life, to hopefully where you can take it to the next step and you can begin to see this, how it works in a real business, because that's just how it works. You mark things up in your business to figure out what you're going to sell it for. All right, so first thing first, let's figure out how we do this markup. When you have a markup, all you do, and I'll put this down here in my answers, as the markup, you take your base cost and then you multiply by 1 plus decimal, markup. Okay, so now we'll put this in the numbers now so you can see how it works. The decimal markup, if it's 30% as a decimal, that's 0.3. So if we want to see what we're actually selling this item for, we take the Prius, 14,000, and then times it by 1 plus 0.3 for 30%. And if you just do the easy math on your calculator now, 14,000 times 1.3, I'm selling the asset for 18,200. That's my sale price. This was my base cost. This is going to be my cost of goods sold. This is my sale price. And then the only other thing that I need to tack on is not only am I going to sell it for 18,200, I'm going to sell it for 5% more than that. So what you can do it one of two ways. You can just tack on 0.105 to see what your final sale price is, or you can just see what the sales tax is. I'm just going to see what the sales tax is. I'm going to multiply by 0.05 for 5%. So if this is my sale price, my sales tax is 910. These are the two things that together what I'm actually, my customer is paying me or they will pay me. And in this case, they are going to pay me. It says it's on account. So my account receivable will be the 18.2 plus the 910. When you add those up, I got 19,110. That's what I'm getting. I'm getting that. Or I'm getting that as I promised to be paid. Now, where did that 19,110 come from? Well, that's what my work up here was for. All of this is where the 19,110 came from. So my credit is my sales revenue. That's how much I get to keep as the seller. And then the rest, I have a new account called Sales Tax Payable, or STP. Sales Tax Payable, like accounts payable, just naming it what it is, sales tax. Now we put these into our account here. We've got on let's just call it 2-2, second day of February, 19,110. And then we have a sales revenue. So come over to our sales revenue account. 2-2, we had 18,200. And then finally, we had sales tax payable. And we look down to our liabilities, and we actually have to come over to our additional liabilities. And here we have our sales tax. 2-2, we owe the IRS $910. That's not my money. I'm just the middleman. I'm just holding that. The customer paid me. I then pay the IRS. Now, we're not done yet because I don't want my books to end up and say, hey, we made a profit of 18,200, because that's not the case. Yeah, I made sales revenue of that, but final profit, well, I bought that Prius and I had to either pay for it or I will be paying for it. So I need to show that I no longer have the Prius. I need to show that my cost of goods sold is that 14,000. That's how much I actually got rid of. And then I show that the inventory went down by 14,000. Think of this very similar to using supplies. When we use our supplies, we debit the supply expense and then credit our supplies. In this case, it's just inventory. And instead of calling it inventory expense, you call it the cost of goods sold. That's just the terminology that's used. All right, so let's go up to our new account, our cost of goods sold, the one we haven't used yet. 2-2, it's 14,000 for the sale of the Prius, and I get rid of on my inventory On 2-2, sale of the Prius, 14,000, credit the inventory. Keep going back to my notes. So on this one, my notes, all I would have shown on my notes is our very first, but we're going to have 2 journal entries. When we sell inventory, we're going to have our normal sale, and then we're going to show that our inventory is being taken away, and we need to debit the cost of goods sold for the cost of that inventory that I bought it for. Not what I sold it for. What I sold it for goes up here in our sales revenue. This is what I sold it for. This is what I bought it for. The two together then tell me how much profit I made. Okay, we're ready to move on. And when we move on now, for most of the rest of these problems, we're actually going to look at it from 2 different standpoints. We're going to look at it from our standpoint, Auto World, and we're going to do the journal entry. And then we're going to look at it from the manufacturer, or we're going to look at it from the other party, whoever the other party is. In this first case, it's the manufacturer. When we do the T accounts, I'm going to be showing journal entries for both, but I'm only keeping the T accounts for us, Auto World. I'm not doing T accounts for the manufacturer because I don't have all their beginning balances. Remember, our beginning balances was simply cash and capital of 50 grand. I don't know what they are for the manufacturer. I don't know all their back history. So I'm not going to do their T accounts. I'm just going to show what it would look like if they were to do this one transaction. All right, Auto World. So now we're, again, the buyer. We bought inventory in number 1. We sold inventory in number 2. Now we're actually buying equipment in number 3. It works the same way as buying inventory, same process. So we're buying 20 computers on account to help our business run. Each computer costs us $800. That's what the manufacturer is selling it for. There's a 5% sales tax, and the manufacturer, when they're looking at it from their point of view, it costs them $500 to make the computers. All right, so we need to do the journal entry. Let's look at the journal entry from Auto World first. From Auto World's perspective, we've got to ask ourselves, what are we getting? Well, we're getting equipment. And more specifically, we're getting computers. So we're going to debit our computers. We're going to debit it for not only just the base cost. So we have 800, and we bought 20 of those. So not only is it 16,000, but whenever you go to the store, it's not just the base price that shows up on the register. It's the base price plus the tax. So remember, as part of our notes, and this is a good time to bring this up, as part of our notes, when you're buying inventory or you're buying equipment, remember the key here, any cost that gets that item ready to use or sell, sales tax being one of them, we include that into our price of the equipment. So I want to see now what the sales tax by itself would be, times it by 5%, an extra $800. So now when I do the journal entry, I'm getting computers or equipment. You can call it both, equipment dash computers, if that fits. I'm getting equipment, and let's say I don't give us a date, let's say it's 2-3. I'm getting equipment for $16,800, not just $16,000. I put the sales tax and the price together. And then it tells us in the problem that I'm buying it on account. So I've got the AP manufacturer as my credit because I'm not paying cash. So I come down here to, I already have an AP for the car manufacturer. Now I've got the AP for the computers, the computer store. And on 2-3, that was, I owe them $16,800. I owe them the price, their price, plus the sales tax that they have to collect. Just like we have to collect sales tax from the IRS, for the IRS. Now, there's nothing else that I need to do. If I was selling stuff, then yes, I would have to do a second entry, but when I'm buying it, I just simply buy it, and that's it. Now I'm ready. Let's go ahead and look at what this would look like from the other point of view. What if I was the seller? What if I was the computer manufacturer? How would I do this entry? Well, what I would like to do is, and what I would suggest you do is make a little off to the side. What is the manufacturer really getting? They're getting sales revenue for 16,000. They're all, or what are they collecting? They're also collecting sales tax, 800. So total, when you combine these two, what they're getting is an account receivable from me, Auto World, for 16.8. So they're looking at it as an AR from Auto World. That's us. They are looking to collect $16,800. And then they say, well, where does that $16,800 come from? Well, most of it came from sales revenue, and the rest came from the sales tax that I owe to the IRS. Now, from the buyer standpoint, I don't need to differentiate between the cost and the sales tax because I'm paying the sales tax it's already paid for, or it's included in this. I include it in the cost of my equipment. But the seller, they need to break it down because they're collecting and keeping 16 grand. They have to pay on 800. Now notice I'm not putting this in my T accounts because these T accounts are for Auto World only. I'm not doing the T accounts for the manufacturer. Now, the manufacturer isn't done yet because they didn't make pure profit of 16 grand. Remember, that's what I had this little piece for. The manufacturer is selling them for 800, but it costs them 500 to purchase or to make these. So then they need to say, okay, it cost us 500 and we sold 20 of them. So we have a cost of goods sold for 10 grand. Get rid of our inventory for 10 grand. So in pure profit stand, they made $6,000 instead of really 16. Now let's take a look at what happens if I decide, and this is looking at it from purchaser still, I decide I don't need all 20 computers. 3 of them are either defective or I just simply don't need them and I return them. Okay, so let's go ahead and return some of the items. So when I return some of the items, since I haven't paid yet, I'm going to get a reduction on what I owe. I'm going to get a reduction on both the cost of the item and the sales tax, because it's like the sale never happened, so they have to take off the sales tax as well. So what I want to do is I want to say, okay, it costs $800, and if I return 3 of them, base price, they're going to return to me $2,400, but then we need to tack on 5% more for sales tax. So they're going to return to me not only the $2,400 off of my bill, they're going to take an extra $120. So total, $2,520 is going to come off of my bill for the cost of the computers and then the sales tax. So that would be my debit. Debit $2,520 on, let's call this 2-4. 2-4 for $2,520. Now I'm going to put in an extra line or two here so we can, if we wanted to, we could total this up. So if I wanted to go ahead and balance this out, I could see what I owe. I owe the 16.8 minus how much I returned. So my bill would be $14,280. And then the computers, I'm returning 2520. So I come down to my computer account, 2-4, and show that I have 2520 as a credit. And then if I wanted to balance this out, I could easily do that at this point. And it shows how much in actual computer costs I have. 14,280, which was the same then as the account payable. Now let's do this from the seller's point of view. We're not going to do the T accounts, but we can see how the T accounts would be affected. So the manufacturer, whenever there's a sales return is going to look just like a sale. It's going to have these two journal entries, except when it's a sales return, everything is just flipped. And the only thing that changes is this account. And instead of calling it sales revenue, we call it the new account called sales return. That was in our notes, that was one of our new terminology that we needed to know. Sales return, it's a contra revenue account, so it's backwards. And whenever we do have a sales return, we're going to have at least two journal entries. Okay, so we have a return of 3 items. Let's go ahead and start making a little list of everything that's going to happen. We have a sales return. Remember, they cost $800 when I sold them. So 3 of those being returned is $2,400. And then I have sales tax that I have to give back. So I just did this reverse. Now I'm ready to do this. 5% of 2,400. We already did that over here. So I'm giving back 120, or they're giving back to me 120 off of my account. And then I'm going to credit the AR account because my client, remember I'm the manufacturer, my client, AR Auto, doesn't owe me that 2520 anymore because they returned the computers. Now I can't stop there. I also have to do this entry backwards because this indicates that I sold 20 items at $500 a piece, but I didn't. I sold 3 less than that. So I need to do 3 less down here. I need to show just a reverse. Here I debited cost of goods sold, credited inventory. I'm just going to do just the opposite. Debit my inventory for the $500 times 3 items and credit the cost of goods sold. Again, all the while, I am not I am not putting the T accounts over here because this is strictly Auto World's amounts that I'm keeping together.